Hello, everyone, and welcome to December's Pensionmark webinar, where we'll be discussing a recap of the market's past quarter performance. We appreciate all of you taking the time to join us today. A few items to go over before we get started. First, in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end, we'll take some time to go through these. And now I'd like to introduce our guest speaker of John Hancock, Matt Miskin. Matt is a member of the investment research team at John Hancock Investments, where he focuses on capital markets research. Matt's primary role is to analyze and synthesize macroeconomic, fundamental, and technical research from top-tier independent investment strategies. He also works closely with John Hancock Investments' major oversight team to obtain real-time understanding of investment trends based on the firm's platform of world-class asset managers. Matt joined the company's investments division in 2014. Prior to joining John Hancock, he was a manager, due diligence analyst at LPL Financial Research, and was a part of the team that managed their discretionary model platform. Matt holds an MBA from Babson College and a BS in Finance from Ellen University. He has completed level 2 of the CFA program. Thank you so much for spending the time with us today, Matt. And with that, I'll go ahead and turn it over to you.
Thank you, Tori, and thank you for those at Pensionmark that have asked me to be on today. What I'd like to do is cover John Hancock Investments Market Intelligence publication. This is actually a forward-looking quarterly piece that we put together, which covers the global markets, and we have found it to be a useful tool for investors as they go ahead and look at their portfolios and their investments and try to decide how to position for the future. So with that, I'm just trying to get to the, oh, here we go. What we're going to be covering today is first we'll just talk about John Hancock Investments, briefly go over how the firm is structured and how we leverage the organization to put together this piece. Then we're going to talk about some major macro themes that we're hearing from our network and how that's going to play out across asset classes. The major asset classes we're then going to cover U.S. equities, international equities, and fixed income. And we'll leave with some takeaways of how to potentially position your investments as a result of some of the things we're seeing in the markets. So with that, let's start with John Hancock Investments and just go over this quickly. We are a manager of managers, so our philosophy is pretty simple. We're looking for the best strategies possible around the world to make them available for end clients. This is a relatively unbiased way. We don't look at only internally for different places to invest. We will look anywhere in the world and we'll try to find the best strategies out there. What this has led to is a relatively unique structure. And this structure enables us to find out a lot about the markets. We have daily discussions with portfolio managers, some of the best investors in the world, whether it's how they're managing their portfolios, what they're saying in their outlooks, or if they're shifting around asset classes across their strategies. This information puts us at a very strong position to put together a market outlook. And what you're going to see is that what we've done is we've accumulated all that information for you and put it out to you in a relatively unbiased way for you to see what we're seeing in the markets from our platform of different strategies. So across the conversations that we're having with all the asset managers that we do business with, these three themes are what are coming up across the board. First, oil lower for longer. This has been something that has played out for the last couple of years, but we're seeing it in terms of the trend to remain intact. we've come from $100 a barrel as of this morning. As of right now, we're at $28 a barrel. That is going to have implications across asset classes, and we're going to touch on that. U.S. dollar staying strong. So the Fed is raising interest rates. They did in December, and there'll be more talk as, March is the next meeting, but Yellen is going to be speaking tomorrow in front of Congress. And the dollar has been the safe haven currency that has appreciated while other currencies around the world have depreciated. And this is going to have ramifications for investors internationally. It's going to have implications for bond investors as it relates to inflation versus deflationary forces. And we're going to touch on how that plays out. And then monetary policy, global divergence. I just spoke of Fed Chairman Yellen and what the Fed is doing in terms of raising rates. Other places in the world, their central banks, whether it's Europe, Japan, China, they're really trying to stimulate their economies, and they're not trying to tighten. As a result, that is going to have tailwinds for equity prices internationally. It's going to have impacts into global bond investors, and it's also leading to greater volatility in markets. And so those are things that we're going to touch on. What you're going to hear throughout the presentation is that these things often will come up while going over different asset classes. So on this slide, what I'd like to do is first review what it's showing. So on the left-hand side, what you see is the major themes that I just spoke of and how that's going to impact our first section, first asset class we're going to cover, which is U.S. equities. On the right-hand side is what we're hearing from our network. The shading represents the most concentration. So let's go over an example. U.S. equities. The darkest shading is in the middle, meaning neutral. So what this means is if you have an allocation to U.S. equities in your long-term kind of investment policy statement or in your long-term way of investing, we would recommend holding that allocation to U.S. equities, and as does our network. The lighter the shading means there's less and less views that fall into that. Now, bearish means negative on the market, which is all the way to the left. Bullish means positive on the market, thinking that the market would go higher versus lower. In terms of beneath that, what you have is U.S. large caps. So the network prefers large cap stocks relative to small cap stocks. They prefer growth stocks versus value stocks. Now what you'll see at the bottom here is the golden caret represents John Hancock investments. So what we do is when we take this information, we do arrive at a view. Now what our view would be is driven from listening to different people in our network. So say, for example, we hear a U.S. equity strategist that we trust, that we have allocated capital to and believe they have greater insight into the markets. We might weight their opinion more than others. And as a result, that golden caret might be different than the shading. For example, growth versus value. John Hancock Investments is actually neutral, while the network likes growth over value. I hope that's relatively clear, and you're going to see this throughout the book. So if we're going to continue to hit on it if we didn't get it fully covered there enough. But what's inside in the bottom left here, this is what we're going to cover within the U.S. equity section, and let's just get started. So on the next slide, all right. The first slide here is the leading economic indicators. This is produced by the Conference Board, which is actually a third party. It's it's not part of a financial institution. It's just kind of it's similar to the Bureau of Economic Analysis. So they have an unbiased view on the markets, and what they do is they provide leading economic indicators. They've been doing this since the 1950s, so there's plenty of a track record. And what the chart is showing is the green bars are positive year-over-year readings in the leading economic indicators. The blue bars are negative readings of leading economic indicators. And what we have shown, or what we've seen, if you go back to 1950, this chart only goes back to 1999, but these indicators in aggregate have gone negative preceding each of the last 7 recessions since 1950. So it's been a pretty good forewarning of an upcoming recession. And what you can see all the way to the right is, while it is ticking lower, it is still in positive territory. The other thing that you'll see here is what we've done is we've actually laid out the 10 indicators, and they're weighted by the size in the index. And the top of the weighting, the top of the indicators are the heaviest weightings, and what you're going to see is the weekly manufacturing hours worked and the ISM index of new orders are actually negative. Consumer expectations are negative too. They actually did turn positive here in the most recent reading we got after the publishing of this book, but ISM new index is still negative and manufacturing hours worked is still soft. And what this is basically showing is a strong dollar is hurting our relative competitiveness as a manufacturer in the world. And what this is doing is it's providing a headwind for our overall economic growth. If you look at the ISM index for new orders specifically, what you're going to see is the energy sector is a big component of that stress, if you will, in the economy. So what this means to us, though, as U.S. equity investors, is that while growth is slow, it's not forewarning a recession yet. We have to continue to watch this. And we're going to, we publish this every quarter with this page, so if you want to look at it going forward. But right now, still positive, slow growth. So as long as that happens, U.S. equities should do okay as a result. On the next page, I talked about the Fed raising rates. So they raised rates for the first time in December. We don't know yet where they're going to go from here. They said they're data dependent. But one thing we looked at is going back over history, and I'm going to kind of describe this chart. At the bottom is the Fed funds rate. So that's what they raised, 25 basis points, if you look at the 12-15 on the bottom right. But, if you go back to other periods where the Fed raised rates, mid-2000s, for example, the 1995 period, 1990s, 1985, what you're going to see, if you look at the callouts at the top, is that during those periods, these are S&P 500 returns during those periods at the orange bars at the top. And what you can see is 14.5%, 6.9, 12.6, 7.9. So those are returns that the S&P had during Fed rate tightening cycles. These are not bad returns. In fact, they're right in line with long-term average, including dividends for the S&P if you averaged them all together. The other side, though, that I think is important is that there's drawdowns along the way. So a drawdown is when you take peak to trough, how much money you lost as a percent in a given period. And what you can see is -7, -8, -12, and -7.5. So along the way, there were these pullbacks that you saw during these rate hiking cycles, but overall, the market pushed higher. This is the relatively supportive side to U.S. equities right now. Because the Fed's raising rates because the economy is actually doing okay. We have a good jobs market. There are parts of the economy that are doing well, and that's why the Fed's looking to raise rates. On the next slide, one of the counters to that story of the U.S. equity market doing well is that corporate profits are continuing to decelerate here. And this has really been a phenomenon since 2014. What this chart shows is if you broke down the S&P 500 into the sectors that make up the overall index, and you took their net income as a contribution to the overall S&P 500 equity market, this is what it would look like. So technology at the bottom is kind of your bedrock. It's your foundation. It's had some nice earnings growth or nice income growth over time. Healthcare, financials, consumer staples. If you move your way up, these are all in a positive trend going from left to right in terms of their profits. And stocks tend to follow profits over time. What you're going to see, though, is that 2014 in aggregate was the peak of the S&P 500 companies' earnings. And since then, it's diminished actually pretty meaningfully. What the culprit is energy. The collapse in oil prices, while it's helping some of these other sectors, like, for example, industrials, if you think of like a FedEx or the airlines, the transportation businesses, they are benefiting from lower oil prices. Consumer discretionary, you would think that consumers have more to spend on goods and services because they're not paying as much at the pump. It's modestly helping, but it's not helping enough in terms of profits of those businesses from what's happening in energy. And until this kind of rebalances itself, it's hard to see U.S. equities move meaningfully higher without support from earnings. On the next page, this is a little more granular, and I kind of just want to hit on this quickly, but sector positioning is often something to consider within your portfolio, your equity portfolio, and we do get insight from our network on sector positioning. In this chart, what we're showing is that the bottom horizontal axis is bond price sensitivity. So, and what this is showing is correlation of excess returns. I know that's a mouthful, but I think it's pretty simple when you break it down. So what this is showing is what sectors tend to do well when bond prices outperform the market. All the way to the right would be the bond market outperforming the stock market. Consumer staples tend to do best. They have over a 0.7 correlation of excess returns when bonds outperform the market. If you go to the left-hand side, though, still looking at that horizontal axis, what has a negative correlation to bond prices? Financials. So when bond prices fall, yields rise. So there's all this talk of, well, what's going to happen when the Fed raises rates, or bond yields going to rise? We haven't seen that materialize yet, but in time it should happen. Bond yields have been falling for 30 years. The best sector to own if bond yields rise are financials, based on 10 years of data, correlation of excess returns. Commodity sensitivity is the vertical axis. So what we looked at was, okay, if you wanted to bet on energy coming back, or excuse me, oil prices coming back, like I said, they're at 28 today, they've come from 110. Correlation of excess returns over the last 10 years would suggest that energy tends to do best when oil prices rise, or commodity prices. It's pretty logical. They have, that's what they do. They are in exploration and production of oil, and therefore when oil rises, they tend to make more money. On the other side of that, if you go down the chart to the negative correlation, consumer discretionary tends to do best when oil prices actually fall. And that makes sense too, because like I said, less paying at the pump, more money to spend on goods and services, therefore consumer discretionary better off. In the bottom left-hand quadrant here, what you're seeing is that what our network likes in terms of sectors. It's technology, industrials, financials, consumer discretionary. They tend to be insulated, do better with bond yields rising, and they tend to actually do better with commodity prices fall. So that's kind of the sweet spot. A lot of information there, but the takeaway is that certain sectors might be better positioned right now than others. All right, let's get to the next page. And the final page here, okay. The final page within U.S. equities is just talking about valuations. Let's start just kind of going over this chart. So at the bottom here is a starting PE ratio. So, people talk about PE ratio a lot. It's price to earnings ratio. So it's basically what price are you paying for the earnings of the S&P 500. That's your horizontal axis. Then what you're looking at a vertical axis is your subsequent 10-year annualized return. So this is an interesting example. 10 years ago today, the S&P 500 was trading at 17 times earnings. The subsequent 10-year annualized return was 6.5%. So there's a dot on here that shows the month and date of your starting PE ratio and your subsequent 10-year annualized return. So each dot represents a starting point and then your subsequent 10-year return. And what the chart shows is it's just kind of a relatively simple illustration, kind of if you step back. But at 6 to 7 times or lower PE multiples, the regression analysis, or kind of just the overarching trend of this, would tell you that lower PEs have historically meant better long-term annualized returns. If you go all the way to the right, if you pay a really high multiple, there's been often negative annualized subsequent 10-year returns. It's color-coded, so the 1990s, the tech bubble did kind of drag this up a little bit. But where we're starting today, you know, when this was published, it was at 18 times earnings for the S&P. As of we speak right now, we're at about 16.5. It's still around a 4 to 5% price return that you're going to get, most likely, on average, based on your starting multiple. That's what this would suggest. Now, what can also be seen is there's a wide range, right? There's been 1 or 2 negative points, negative in the 60s, these purple dots around 16 times earnings. If you look at the top, you know, some of the periods in the 1980s have been as high as 12% annualized returns. So the range, you know, there's significant range there. I would say, though, that the trend is relatively intact, and the starting multiple that we're at would suggest about a 4% return. All right, so that wraps up U.S. equities. So that's kind of the, you know, what we're hearing is that you're probably looking at, if you can hold out 10 years, 4 to 6% return, including dividends, on your U.S. equity allocation. There's going to be volatility along the way as the Fed raises rates. Sector positioning can be helpful, but, you know, if you have an active strategy, that's one way to play that. Overall, we're neutral. All right, let's go to international equities. International equities, the network is definitely, the asset managers in our network are more positive and have found more opportunities there. Europe, Japanese equities, and emerging markets, it's all on the right-hand side. And then on the left-hand side, we have those major themes, and we'll talk about those. So the first thing that I think is really important, and we talked about this global central bank divergence theme at the beginning of the presentation. Well, the Fed's raising rates. The European Central Bank and the Bank of Japan are really doing as much as they can to create inflation, to spur economic growth. And what this does is it helps equity prices, because what they're trying to do is inflate asset prices, and stocks are considered a financial asset. This chart shows assets to GDP. It's one way of showing how much assets the central banks are pulling out of the system and pulling on their balance sheet, and relative to the size of their GDP. So Japan in the blue line is kind of, I mean, it is an outlier to the upside, and so the Bank of Japan is doing a lot in terms of quantitative easing, you know, buying assets out there in their marketplace to push people into risk assets to try to spur growth. The European Central Bank is the purple line, and what you're seeing is they're starting to do more, so that's beneficial. The Fed is raising rates, so that's clearly the other direction. Eventually, they're going to have to also unwind their balance sheet. They have $4.5 trillion on it, and so we're going to have to see what their next steps are for that. Clearly, they're going in another direction, which would be, all else equal, less beneficial for equities than, you know, what the ECB and Bank of Japan are doing. All right, on the next chart here. So a lot of what we do in discussing with the asset managers on our platform about Europe in particular is how is quantitative easing flowing into the economy? Because the ECB can say they're doing quantitative easing, and that is certainly one thing. The other thing is it helping? And what we have here is we have bank credit flows to households and firms, which is the bars. So the green bars are money going from the banks into the economy. So those are the good. Those are loans basically being made, and those are positives for the economy. Purple bars are when people are going and putting money into the banks faster than they're taking it out. So in essence, they're taking money out of the economy. And you know, you want to call it putting it under your mattress. I mean, it is going into a bank, but what they're doing in those purple bars are not necessarily good for the economy. And what you're seeing is 2014, 2013, a lot of credit flows were out of the economy. And we're starting to see these green shoots, if you will, where credit is starting to flow into the economy. That should be beneficial. The blue line is sentiment. Sentiment is just going out and asking firms or consumers, what do they think about the economy? What do they think about business prospects? And that's been relatively positive. You know, not where it was in 2007, but the trend is relatively stable and generally moving higher. The final bar at the very bottom is GDP. We're looking at about 1.5 to 1.8% GDP growth in Europe. It doesn't sound great on an absolute basis, but this is coming off a double-dip recession that you can see in 2011, 2012, where they had negative GDP, and the U.S. is only growing at about 2.5%. So 1.7, let's say, of GDP growth in Europe is actually not that bad. The next chart here, this is just talking about Japan. You know, I think this is a relatively small part of investors' portfolios, so I don't really want to do as deep of a dive here. The overall takeaway is that the corporate fundamentals are positive for Japanese equities in our network's view, and that should bode well for Japanese equities going forward. Finally, emerging markets. Again, this should be a relatively small part of a global balanced portfolio. If you think of, you know, equity portion within a portfolio, the all-country world index, emerging markets are relatively small allocation compared to U.S. The U.S. is usually about 50% market capitalization of global equities. You're looking at, you know, maybe 10% or less in terms of emerging markets. But within emerging markets, there's a certain story that is playing out that we're hearing. One is that oil exporters are really in trouble here with lower oil prices. So like I said, we're at about $28 today from 110. That is causing some issues in emerging market countries such as Russia, Brazil, and even Mexico to some extent. The other side of that coin, though, is that there are a lot of importers in China, and they tend to be big parts of the index, which often is kind of misunderstood. So China is a big part of the index, Taiwan, India. India specifically is a place where our network likes and sees good growth prospects. You can see the GDP growth is about 7%. So there are parts of EM we like. There are parts of EM that we would certainly not favor. Overall, the valuations and how far they've come back in terms of their performance, we wouldn't sell out. We would likely call more of a neutral stance, so that kind of relatively small weighting as a market capitalization perspective in portfolios, but some allocation based on this kind of concept. So the final thing that we wanted to talk about within the international equity section is currency. Currency risk is one of the debates that we often have here. And, you know, as we talk to our managers, we often ask them, do you hedge currency or do you not? If so, why not? And what this shows is it's the hedged version of the MSCI EFA index, that's Europe, Australia, Far East index. And if you hedged, this is rolling 10-year periods. Those are the aqua bars or aqua spaces at the top. And those are the periods that hedging would work or outperform unhedged. The bottom in the purple, though, is when unhedged outperforms. And what you can see is that unhedged at the bottom is actually often outperforming hedged. You know, the dollar usually weakens after a cycle of strengthening, and when it weakens, your international allocations, you get a currency benefit from that change over time, and that's ended up being more of a tailwind than a headwind for most investors over the long term. Now, this is rolling 10-year returns, so you got to think about it long term. We often think that investors have some international equity exposure in their portfolios, so it makes sense to think about it longer term. All right, so that is the international equity section, and this is the final section, but probably the most relevant to investors today, and that's fixed income. The overarching message that we are hearing is that flexibility is key. Like all the other starting pages, we have on the left-hand side, the major themes. On the right-hand side, we have our network views and the sub-asset classes within fixed income. So overall, we're not hearing a lot of great things about fixed income. We're looking at a 10-year yield on a treasury bond as of this moment of 1.7%. Not a lot of return potential. Typically, your yield to maturity is the majority of your long-term return. And at 1.7%, that's not a great value proposition. The benefit of fixed income, though, in terms of the higher quality bonds, is its diversification. So your equity portfolio, when your equities go down, your fixed income should hold in relatively well. In this recent pullback, we are certainly seeing that. But we would, on the margin, underweight government bonds. If you think about a Barclays aggregate, U.S. aggregate index, the treasury bond component is pretty significant. Probably about a third of the portfolio to 40% are government bonds. That might be a little much, but it depends on your own investment risk tolerance and what you're looking to do with your portfolio. But in terms of our network perspective, we would trim on the margin there and reallocate. We still like high yield here, although there certainly are some signs of stress, and we'll cover that. Investment grade bonds, corporate bonds, we are neutral, so if you have an allocation, we would keep it. And the last two are they're less topical, I think, in a typical investor's portfolio, but we'll touch on them a little bit. All right, in the next slide, this is looking at countries around the world and giving a snapshot of 10-year, 12/31 yield to maturity. It's also overlaying that with their credit rating. So credit rating is kind of a measure of their credit quality, AAA being the highest in this representation, B plus to triple C's being the lowest in this illustration. And what you're going to see here is that the highest quality bonds in the world, in the greenish colors, have very low yields. The U.S. was 2.3 at the beginning of the year. Like I said, it's 1.7 now, so it's clearly fallen in terms of yield. That means the bond prices have gone up. But other places, it's the high quality bonds out there are yielding very low yields. This is just a phenomenon around the world. If you want to get a higher yield, or like I said, the yield to maturity is typically your largest return component. If you want to get a higher return from bonds, you got to take credit risk, and that would mean lower credit ratings. Brazil's got a 16% yield, Russia's 9.4. It sounds great, but there's a lot of credit risk there. The thing that also is important, and this just makes this even more complicated, on the right-hand side, we've added as an illustration currency returns. So Brazil, for example, it's not on here because it's not one of the major currencies of the world, but that 16% looks great, but the currency was down 30% last year. So if you bought it in their local currency, or using US dollar currency and translating it over to their local and back, you would have not made money on that. You would have lost 14%. So just something to consider. We do like active fixed income strategies. I know in like investment portfolios, they typically are available. We think you have to be careful and do your homework and find out what is in them, using a Morningstar or what have you. But there are some good ones out there to consider. And they, hopefully an active manager can look at these risks as well as potentially generating more returns. All right, on the next page, if we just focused on U.S. government bonds, one of the things I think there's been in the media is a lot of fear of rates rising, and then it's going to cause significant sell-off in government bonds, and we don't see it that way. We see it as there's factors pushing rates lower, which is at the top of this chart, and then factors pushing rates higher. And in the middle is the 10-year U.S. Treasury yield. I've talked about that a little bit, and the 2-year Treasury yield. And if you look at the factors pushing rates down, I talked about it a little bit, but the U.S. yielding 1.7% right now might sound low on an absolute basis, but if you wanted to buy a government bond anywhere else in the world, that's actually a high-yielding bond for a high-quality issuer. So international investors are actually coming here to buy our bonds because they think that's a good pickup in yield. A strong dollar adds to deflationary pressures. So as we have a stronger dollar, we're buying things at lower prices. When we import these things at lower prices, that's deflationary. In essence, that's pushing down the prices. If we have deflationary forces, that's actually good for bond prices, which would keep yields down. So these are all things that are keeping yields down. Inflation expectations below 2%. Basically, the market is not really buying that Yellen or the Fed is going to be able to spur inflation at this point. They think that oil being low and lack of growth globally is going to keep inflation low. With low inflation, your bonds should be okay. And then labor participation rate remains low. So that's kind of the only knock on the overall jobs market, is that the labor participation rate is stubbornly low. So there's people that left the workforce in 2008 that haven't come back, and that's kind of weighing on overall economic growth in the jobs market, and therefore bond yields are staying low. All right, there are factors pushing rates higher. At the bottom here, consumer price index. If you look at core, so this is X, food, and energy, which tend to be the more volatile components, it is at 2%. That is the Fed's target. Now, they don't use that index specifically, but it's an index that does show that there is inflation out there. As a starting point. Over 2.6 million jobs were created over the last 12 months. This latest jobs report was only about 150,000 jobs for January, but nonetheless, there was wage inflation, and 150,000 jobs is not bad either. There's 5.4 million job openings, so there's still over 5 million jobs. This is the job layover and turnover report. And what it's showing is that there's jobs out there that people can fill, so there's runway for the jobs market from here. The bond market believes that there will be fewer rate hikes in 2016 in the Fed. So if the bond market's wrong and the Fed does raise rates, though, then there's going to have to be a readjustment, which is going to push yields higher. But overall, the overarching message is your fixed income isn't going to see this, kind of bloodbath that the media has depicted. You can see losses in fixed income from interest rate risk, certainly a possibility in your government bond allocations, but that doesn't mean that, if the Fed raises rates 25, 50 basis points this year, you could probably see, maybe slightly negative returns as a result. Nothing too overly scary about that. This is a more in-depth representation of the Fed path. I think this is a little maybe inside baseball, but let's go over it kind of quickly here. So the Fed 4 times a year comes out and gives guidance about what they think the Fed funds rate is going to be over the course of the years to come. Those are these dots. So there's members of the FOMC that come out and they give these projections. And what they basically said in December was that they're going to raise rates every other meeting. This looks way optimistic now. It's amazing after 12/31, this is where it was. But as of today, that's probably very optimistic. But that would be where this kind of the teal line goes up. That's where the Fed funds rate would go based on these projections. The other side of that, though, is you can look at the bond market and find out what they're pricing in. That's just the global markets, and Fed funds futures is what it's called. But you can see where the bond market is pricing in rates to go. And as of December 31st, they were thinking every fourth meeting. And in the bottom right-hand corner, what you can see is there are 8 meetings a year. We just had one in January. They just have a statement. In March, they actually have a press conference. They have a Q&A. So that one's going to be very important, March 15th and 16th. And that's where they're going to provide new projections about where they think Fed funds rate is going to go. But the bond market is basically saying the Fed's going to maybe raise rates once or twice this year. And the Fed had said more like 4. Right now, we're citing in between, and maybe it's 1 to 2 times this year. Financial conditions are certainly under stress right now, so that would bode for a much shallower path, much less rate hikes in the future than what they expected as of December 31st. All right, next slide. High yield, it has been a tough asset class to own. The price of high yield bonds have fallen. The yields have risen. And what you're seeing here on the left-hand side is a chart showing the current yield and the duration. So if the Fed does raise rates, duration is kind of your interest rate sensitivity. And what we're showing is that high yield is furthest to the left. So they have of the lowest duration across fixed income asset classes. The current yield is way higher than that of other fixed income asset classes. So you're getting paid roughly 9% now to own high yield bonds. Doesn't mean the price, the price could fall further, and that's certainly something to consider. But for those that have a higher risk tolerance, we do think it's a compelling value opportunity. One of the things on the right-hand side to watch out for is the energy component. As we mentioned a couple times now, oil's at 28. That's going to cause issues for energy companies, and that's meaning that high-yield spreads in the energy segment. So their bond prices are falling, their yields are rising, and that's showing distress within the energy segment. The overall economy, though, as long as it's not in a recession, we talked about at the beginning, high-yield companies should do okay and should survive this, and high yield would be an attractive value opportunity as a result. Again, as I mentioned, it is a higher risk asset class. There's credit risk involved, so you have to be careful. But if you have the risk tolerance, it might be an attractive play. All right, next. This is the final slide across asset classes. What we show is on the left-hand side, we're using PE multiples as your valuation starting point. These have come down in recent weeks here with this tough start of the year. Equities valuations are coming down, so that's a good sign for a starting point. It's valuations aren't everything, but it's something to consider. On the right-hand side, as I mentioned throughout the presentation, your yield to maturity is kind of the biggest part of your return, and therefore is kind of your starting point is a valuation proxy of the bonds you're going to buy. We have bond indices here and their yields. The bars show the 10-year min, max, whether it's PEs on the left or bond yields on the right. And what you're seeing, the gold bar in the middle is the median. Bonds on the right are expensive. And this doesn't even show the 1.7% we're seeing on the 10-year right now on the Treasury bonds, but it's pretty low. So bonds are expensive. Equities are getting a little cheaper. I think what this actually does a better job of illustrating for most investors is the concept of rebalancing over time. So as you have your portfolio and you have kind of your stated stocks allocation and bonds allocation that you want to have given your investment risk and how you think about risk. Over time, if your bonds tend to do well and your stocks underperform, you want to rebalance to make your portfolio near what you want as your stocks bonds allocation over your investment time horizon. So as stocks get cheap and bonds get more expensive or bond prices go up, you want to rebalance to sell some of your bonds, put it into stocks. And then vice versa. If stocks get expensive and you start seeing stocks overwhelm your bond allocation, you want to sell stocks, go into bonds. It's kind of a fundamental thing within investing in portfolio management, but I think it's often lost with investors over time. If they have their 401k, they just kind of set it and forget it. But you want to stay on this because your risk balance can get out of whack. It also helps you with your this valuation concept, because what you're doing is you're selling an expensive asset and you're buying an asset that has fallen in price, so lower priced assets. So all in all, across the board, U.S. equities were neutral. International equities were slightly more optimistic because of quantitative easing in international stocks or markets and their central banks. And then fixed income, we would stay flexible, but like I said, you got to do your homework in terms of what you're looking to buy. And then overall portfolio considerations, it's probably a mix of passive and active, and you got to think about volatility and the strategies you're looking to allocate to. It depends on what you're looking to do. So with that, Tori, I'm actually that basically concludes the presentation. Is there any questions from the audience?
Great. Thank you, Matt. We really appreciate you sharing your time and knowledge with all of us here today. And as Matt mentioned, everyone, we're now going to go ahead and start addressing some of the questions that have been filtering in. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. Let's go ahead and shoot over to our first question. Our first question for you, Matt. I'd like to retire in a couple of years. The only thing going up is real estate. What % should I put in TIAA real estate? I have most in a life cycle fund, and it is losing.
All right. So I would say real estate is going up. Doesn't mean that it's going to be going up forever. The forward-looking view that we have on real estate is that it is relatively insulated. It depends what kind of strategy. I don't know the TIAA craft one specifically, but you got to look at the geographic footprint of it. I believe that one's probably more U.S. centric. So the U.S. side, real estate has done well, and kudos for you for looking at it or owning it. But if the Fed does raise rates, real estate is very sensitive to that because they tend to use leverage, they tend to borrow, and borrowing costs, if the Fed raises rates, is going to hamper that leverage and borrowing costs. So I think you got to be careful on that. I also would say that it does tend to be a good late cycle performer, but if we are kind of heading into a period of softening economic growth, like we discussed with the leading economic indicators, real estate will also be hit in time, and will probably be hit more so at the end of the day in terms of a more prolonged softening of the economy. So I would caution, I think it makes sense at some level of allocation, but if you're looking to retire in a relatively, I'd say short to intermediate time horizon, I really wouldn't load up on real estate. I think the life cycle target date type strategies are a great simple solution to go ahead and have you invested in multiple asset classes, to have you diversified, and to think about the glide path, if you will, of your stocks bonds allocation. And I would say that real estate isn't the only thing going up. Bonds are doing pretty well. Bonds are up about 1% year to date. It's not great, but they are positive in terms of, if you look at your higher quality bonds. If you're looking to retire soon, you probably would like a more biased portfolio to higher quality fixed income, to think about higher quality or lower risk assets, short duration type assets within the fixed income side. But I really don't think a target date or target risk is probably a simple solution that doesn't warrant a huge allocation shift to real estate at this time. Just my take on it, but that's what I would say.
Great, thank you, Matt. Our next question, I'll go ahead and answer. It says, will we be able to get a copy of this presentation? The answer is yes. About 2 weeks after this webinar, everyone who attended will receive an email that will include a link to the webinar replay, but it will also include a link to be able to download the PDF version of this presentation. And it doesn't appear that we have any more questions at this time, so we'll go ahead and wrap up today. Thank you again, Matt, and thank you attendees for your participation. I hope everyone has a great rest of their day, and we look forward to our next webinar series with you. Take care.